Um, okay, great. We're going to get started. Thank you for everybody who had gotten back to me. I know everybody can hear me now. Welcome, everybody. My name is Pete Panito, and I do community outreach and business development here at First Northern Credit Union. And we do these financial wellness webinars not only for our members, but the community at large. Financial education is one of our core missions here at the credit union. And although I'm still working remotely half of my time, I'm usually out at the Evanston branch. And for those who aren't aware, we are indeed the credit union for Northwestern University and Northwestern Medicine. And we also are the financial education partner for the city of Evanston. And this is why we're presenting this today, solving the mystery of credit reports. And so we're going to get right into it. If anybody has any questions during the presentation, please ask me in the chat area. I'm kind of flying solo today. So usually if I can't, during the presentation, if I can't answer it while I'm doing the presenting, definitely I will follow up with answering those questions at the end of the presentation, okay? I put some handouts up there. You can download them. One is the handout of this presentation, or that goes along with this presentation. I will create a PDF file of this PowerPoint presentation as well. I will send that to you in the next day or so. Along with, you can also download, we have a certificate program, an e-module program with our partner Balance that we worked out through the city, and I'll get into that towards the end of the presentation. But so here we go. A lot of stuff to cover. The objective here in this presentation is to share with what the credit reports are all about and what's inside these reports. I'm sure you all know the basics. We dive just a little bit under the hood with these things. We always hope when we do these webinars that although it's pretty basic stuff, we hope you walk away with just a little bit more information than when you first arrived. So here we go. I'm technically challenged, so let's see what happens. I'm going to go to the first slide, credit bureaus. Okay, so these are the three major credit bureaus: Equifax, Experian, and TransUnion. They're also referred to as credit reporting agencies, CRAs. The credit bureaus are required by the Fair Credit Reporting Act to compile accurate information that is sent to them from creditors and to provide credit reports to businesses that pay them money for the information. Theoretically, all three of your reports should be the same, but they aren't, because although they have the same information from the reporting creditors, they have slightly different algorithms that compile the score, and we're going to get into that in a bit. And by the way, creditors also, they don't always report their information to all of the bureaus. It depends on the respective company's policies and protocols and all that stuff, okay? But the obvious creditors that look at the credit reports are, banks, retail stores, mortgage companies, and they take a look at not only the credit score, but what's inside the credit report. The devil is always in the details, right? And that's and the only way they get that is when they look at those details, whether they're deciding on, to approve or your application for a loan or a credit card or a line of credit, that kind of stuff. Then once you are approved, then they need to decide on what interest rate they're going to charge you once you are approved, the rate of borrowing the money. There are other not so obvious creditors that are also looking at these scores, like insurance companies, building management companies, employers. So yes, the credit score does come into play when looking for a job, potential employers are checking credit these days. They have been for a while. Utility companies, landlords, they're checking all this stuff. Bottom line here is good credit puts you in a position where you will be eligible for the best rates on all the monies that are borrowed, and it shows creditors that you are financially responsible. Next slide. Okay, Fair Credit Reporting Act. So this is a law that's designed to promote accuracy, fairness, and privacy of the information in the files of every consumer reporting agency. And any violations should be reported to the Consumer Financial Protection Bureau, since that is the governing body that regulates the credit bureaus. On page 1 of the handout, it has detailed information about FCRA and contact information for the Consumer Financial Protection Bureau. And this slide really shows just the bullet points of what consumers have access to. And on the handout, you don't necessarily need to download it now. I'm going to follow up. I'm going to send it to you. But so before the presentation ends, yeah, you should download it if you can. This particular handout, and I've done a lot of these presentations, this particular handout is probably the most efficient handout that I've come across. It's awesome. It gives you all kinds of information, and it's great to, once you do download it, print it out, keep it somewhere for reference in the future. Okay. Next slide. Obtain your credit report. So one of the points on the previous slide is that you personally have access to your credit report. So you should check out the report for accuracy at least once a year. And reports can be obtained by ordering them through the bureaus or for free, which we recommend through annualcredit.com. Again, that's on the handout as well. And annualcreditreport.com, it's a legitimate website that actually it's jointly operated by Equifax, Experian, and TransUnion. And you can request those for free. And when you do, we suggest you stagger those requests out throughout the year, so every 4 months, so you are always up to date on the balanced sheet snapshot of your credit report throughout the entire year. So let's say today you request one from Experian, then 4 months from now get a free one from Equifax, and then 4 months after that request one from TransUnion. So we can always keep an eye out and see if there's any changes, any negative things that pop up, or mistakes. Happens all the time, erroneous entries and possible ID fraud, which is a big deal. And you can always dispute any of these things on the report. By the way, there's also creditkarma.com, which actually I prefer. It's free, but they give you your credit score as well, not just the trade lines and the information on the credit report that annualcreditreport.com does, but it actually gives you your score as well. We don't really we recommend annualcreditreport.com because they're not trying to constantly sell you stuff like Credit Karma does. They're trying, they put all kinds of, almost predatory like stuff in your face. Like, more credit cards, get more credit cards and all that stuff. But, just be careful when you do use them. And when you go there, these things are going to pop up. But it gives you your score as well. So that's why I like them. And I know I mentioned that the Experian and Equifax and TransUnion don't necessarily contain the exact same information. And we're going to get into it. They all use a FICO score algorithm when they're coming up with the credit score for you. And some companies, depending on, again, their protocols. Some companies, when you apply for credit, sometimes they'll use all three credit bureaus. Sometimes they'll take an average of the slightly different credit scores, or maybe they'll just choose one. I think I don't do underwriting here, or I'm not a financial services advisor, but I think we use TransUnion. I don't know if that's exclusionary, if that's a word, if we use them exclusively, but I think that's our go-to. So just keep that in mind. Depending on the company that you're trying to get credit with, they might not be using the same credit bureaus as the next one. Okay. Next slide. Sections of the report. So again, even though each credit bureau will have slightly different information, they contain the main sections, these same main sections. So, and the credit score is just, it's all it is. It's just a mathematical assessment of the likelihood that you're going to repay what you borrow. That's all it comes down to. And the different types of credit related activity that you have, whether it be retail cards or personal loans or mortgages, all that kind of stuff. For each account, it will show your payment history, the initial amount of money that you borrowed for the loans or the credit limit that you have on your revolving credit, let's say, the current amount owed, when it was opened. If you've, I'm assuming most of you have seen your credit reports before, so it gives you all that information, including any public records, any related legal activities, foreclosures, anything like that. And that's all I need to say about that. Next slide. Okay, so trade lines. Okay, so trade lines is a term. It's just nomenclature. The trade lines means each company that you've had credit with or do currently have credit with. It comes under you have the payment history section under each creditor, and each creditor is referred to as a trade line. That's all that means. Okay. But this is where most of the errors will occur. So that's why we encourage you to keep an eye on throughout the whole year, see if anything, any errors come up, any possible ID stuff that's happening. These bullet points show exactly what appears under each creditor, under each trade line. And this is kind of the meat of everything. So next slide. And again, I'm gonna send this to you in a PDF form, so you can take notes, but you're gonna get this information, okay? So how is the credit score? The credit scoring, how's that made up? So FICO, or as I like to say, what the FICO is this? This is the most common used model. There are several other models that I'll address towards the end, but the FICO score is the most commonly used scoring model. Okay, it's the Fair Isaac Corporation, and this is the range is between 300 and 850. Obviously, not obviously, but anything above 800, you're awesome. You're on top of everything. You get the best rates and all that kind of stuff. The average, I think, comes between 600 and 750. But so this is the score that's most used by these three main credit bureaus. And this pie here represents the different weighted categories that go into making up the credit score itself. And these factors are calculated by using the information that is included in the credit report itself. So it's important for you to personally know what's inside these reports, okay? And I want to reiterate again that incorrect information appears all the time, so you want to know what's going on at all times. And again, under each one of these, the trade lines, it has the amount that's borrowed and credit limit and what's owed and all that kind of stuff. I think so. So most scores fall between 600 and 750, let's say. And I think, don't quote me, but I think most mortgage lenders require at least like a 620 or higher. Again, I'm not an underwriter, so I don't know exactly, but I know that there's plenty of consideration, at least with the credit union, if you're dipping below the 620. So that's my plug for the credit union. What else do I want to say before I get into this? And the credit score is important because I did a calculation the other day. It was something like on a $200,000 mortgage loan, 30-year loan. There's a difference between, let's say, if you had a 640 versus a 740, 100-point difference. It'll cost you over that life of that loan. It'll cost you like $40,000. That's a lot of dough. That's a lot of donuts right there. Okay, so we're going to get into this chart. So the biggest factor, 35%, makes up your payments on time. Or conversely, if you make late payments, your score is going to take a hit. So, but this is the biggest factor here. You've got to make those payments on time. Payments on time means that's no longer than 30 days payment after the due date. And the longer it's, so if the payments that are, let's say, 120 days late, it's going to have more of a negative consequence than payments that are, say, only 60 days late. Okay? And the 60 days late will have more of a negative consequence than payments that are only 30 days late. So, make the payment on time, okay? And the next 30%, the next biggest amount, it's called your credit utilization ratio, okay? And this refers to the amount that you have outstanding. It's derived by taking the amount of your current debt, and this only applies to your revolving credit. So like your credit cards, okay? They take the current outstanding debt right at that moment, and they divide it by the total amount of the available credit that you have. And both of those numbers are inside the credit report itself. And this fraction is also called the debt to credit ratio. The simple example is if you have a total credit limit of $10,000 on 3 different credit cards, let's say, and you have a total of $5,000 in debt right now at this moment, you have a debt to credit ratio of 50%. If you had $7,500 outstanding with the $10,000 total available, that's a 75% debt to credit ratio. And the FICO scoring model says, hey, the less outstanding amount of debt that you have, the better. So it's not a good thing to have a total amount of your outstanding debt that gets closer and closer to that total available amount of credit. The lower your debt the lower that ratio is, the better. Again, it's looked upon by the scoring model as saying, hey, this guy, this gal is being really responsible with their credit cards, so let's give him a boost or her a boost in their total credit score. And this only refers to the revolving credit, okay? And the ideal credit utilization ratio should be 30% or lower. And this particular weight is 30% of the overall credit score pie here, okay? And again, I'm going to reiterate one more time because this is where I get most of the questions. This applies to only the revolving credit. Examples of the revolving credit would be your credit card, in the example we just used, but it also includes your personal line of credit, your home equity lines of credit, which is, those HELOCs, the home equity line of credit. And so revolving credit accounts, they let you repeatedly borrow money up to a set limit, and then it's repaid over time. That's the definition of a revolving credit account. On the other hand, installment credit, those are the set amounts of borrowed money, like an auto loan or a student loan or a mortgage. That's installment credit. And that is not, the installment credits are not included in this 30% compilation, okay? So where do we go from here? 15%, what's that? So it's the length of your credit history. So 15% is weighted in this 100% pie. The 15% is how long you've had certain credit. The longer you have had your accounts, the better. And the length is measured as an average across all the open trade lines that you have on the credit report. So it's only the open and active trade lines that will factor into this specific average. So it's a good idea not to close out the oldest open good revolving accounts that you have with creditors. So, if you don't really use a credit card or two, you might want to just close it out. But I'm suggesting that maybe you should keep it open because it actually helps in two ways. It keeps that denominator higher in that debt to credit ratio, which is the total available credit, right? But it also extends the length of credit history. And so now the credit card companies probably want you to charge something every once in a while. I personally have 3 credit cards. I really just use one. The other 2, I've had them for 10 years. The other 2, on one of them, I put my Amazon charge for Amazon Prime. By the way, I just saw that they increased it again for $12.99 to $14.99. Amazon. And on the other card, what do I put? I think I put my car insurance charge on the other credit card. So one charge on each card every month, and just to keep it open. Okay, that's what I do. So anything else I want to say about that? No. Okay, so the next piece of the pie, 10%. New credit makes up 10% of your score, and this factor looks at the number and proportion of recently opened accounts and the number of hard inquiries. So those are called the hard pulls, right? Questions always asked, what's a hard pull? And is this a hard pull? Is this a soft pull? A hard pull is when a lender with whom you've applied credit with reviews your credit as part of their decision-making process. So you fill out the application for a credit card or an auto loan, let's say. That's a hard pull. You actually filled out an application and they're looking at it. A soft pull inquiry would be something like when you personally request to look at your credit card. That's a soft pull. There's credit card companies. You get those little mailers. The 0% mailer, the marketing thing that they have going. Those are soft pulls. They look at your credit score, and that's a soft pull. That's not a hard pull. Credit cards that you currently have accounts with, they check your credit every once in a while. Those are soft pulls, okay? So this 10% is limited to the hard pulls. So if you are filling out applications all over town for more credit cards, that's gonna hit you a little bit, okay? There are 2 financial instruments that are looked at slightly different, and those are the mortgages and auto loan inquiries. If these inquiries occur within a 45-day period, they are considered just one hard pull. Okay, the scoring model creators understand that applying for multiple loans, for applying uh, when you fill out applications in these specific areas, that it's looked at as savvy behavior, okay? Because you want to compare one place to the next. It's not looked at as risky behavior, like if you're filling out all kinds of applications for a credit card, okay? So those are the exceptions to this particular rule, the mortgages and the auto loan inquiries. Is there anything else? Oh, yeah, the only thing I wanted to say that people are always asking about these hard pull inquiries. Just remember, if you already have solid credit, the hard pull stuff, it's not going to affect you all that much. And it's just a slight, for a few months. Now, if you have bad credit and you're doing it, it hurts just a little bit more. But again, it's temporary. It's only 10% of the thing. So you'll take a hit very minimally, okay? So don't let it concern you in a big way. The last piece of the pie here is the types of credit, another 10%. So having different types of accounts, both revolving and installment, is looked upon as positive. So a mix of, let's say, a mortgage and a student loan and an auto loan, and the mix of all that kind of stuff. The scoring model says that this person can handle all kinds of credit card debt curveballs, or all kinds of debt curveballs thrown at them. So the mix is good, and that's awesome. Thumbs up. Next slide. Improve your score. So the answers are in actually the scoring pie that we just went over. So just know that low scores can be improved over time with persistency, okay? The bullet points here on this slide just touches on them, really doing the things that we actually just covered. And I strongly recommend anyone who needs to rebuild their credit, if they are in a situation, please email me. We bring in people all the time to the credit union. We set you up with a financial services advisor. We go through your credit report. We're not there to sell you on any product or anything. We sit down and we evaluate what your credit is all about. We also have a partnership with Balance, and they have a credit rebuilding program that I'm going to get into towards the end of the presentation, okay? But just remember that you can always improve your score. I'm kind of passionate about it because I've been in deep, deep trouble myself, and I finally worked my way out of it. So basically, these bullet points to improve your credit: always pay on time, right? And we know that sometimes life throws us a bunch of curveballs, so we have to negotiate that kind of terrain. But it happens. Just know that you can always improve the credit. Just keep that in mind. These are the bullet points. Again, you can. I'm going to send you the PDF of these things. You can go through them yourself. Okay. And I want to point out that it drives me crazy if I have to pay the interest on a balance of a credit card. So I make it a point for myself, and maybe a lot of you are in the same situation. It's kind of hard to pay off the balances in full, but the only reason I'm able to pay off my full balances of those credit cards each month now, again, it's really just one main one that I use, is because I probably spent about 2 years making extra payments every month to pay down the high balance credit card debt that I had. So now I'm in a position where I am, and I learned quite a lot, where I am now able to pay those balances off in full. So again, just know that it can be done. You want to avoid at all costs taking out additional debt, especially if you're in a situation where you're having trouble paying the current debt, okay? And I know that I had mentioned those mailers that you get, the 0% for a year, whatever, on those balance transfers. Just be very careful with that stuff. Because well, I'll point it out to you in a second, but it's almost kind of like kicking the can down the road a little bit, and we don't want you to do that. I mean, you can, and it helps, and actually that's what I attempted to do. But the bottom line is, I was just kicking the can down the road. Down the road. I wish I just hit it head on like a year before, but neither here nor there. So what I don't want to get lost here. So always keep an eye on your credit report throughout the year. Dispute any incorrect items that you see on the report right away. Again, annualcreditreport.com. Get those reports throughout the year. Keep your old accounts. A long credit history with the same accounts, it indicates stability. And limit those balance transfers, as I just mentioned, okay? Especially with those teaser rates that they come out with, because it affects you in a couple different ways. The accounts will be new, and likely you will have balances that are close to the limit to maximize the advantage of that loan rate. But just remember, it affects you by kicking the can down the road, and in a short term, the utilization ratio is going to be high on those transfers. Okay, we want to avoid that. Avoid excess credit applications. If you do it frequently, a creditor could see it as you need to rely on credit to pay your bills. And again, it's only 10% of the total pie. But if you don't have solid credit already, it's not so good. You'll take a little bit of a hit, okay? And be patient. It may feel like credit mistakes can haunt you forever, but remember that your payment history from the recent past 2 years, let's say, is more important than what happened before that. So we have the power of time in our favor. And the negative stuff, the negative information, is removed after 7 years. I think we get into that in the second slide. Yeah. So positive information remains unreported indefinitely, and that's good if it stays open. Okay. The negative information will come off after a specific time frame, and that is usually 7 years. Again, remember that the negative information that impacts your FICO score, it impacts it less and less as the debts get older and older. And for that reason, your credit is never ruined. You always have the opportunity to improve the score, okay? The only exception here is the Chapter 7. If you file Chapter 7, that stays on for 10 years. Next slide. Correct inaccuracies. Correct inaccuracies. You personally can correct inaccuracies. Again, it's always important to look at those reports. And the fastest way usually is you go to the respective website of the credit bureau, report the incorrect information. Again, it has that information on the handout, and you can dispute anything. And if you actually send them something in the mail, get it certified. That's what I do with my taxes every year too, right? Have it certified. This is proof that I sent this out to you. And this last bullet point, you can include a 100-word statement to explain any dispute that you have, okay? Beware credit repair. So they're really talking about kind of these predatory consolidation companies. Just be aware that these places, they sound attractive, right? But the bottom line is these companies they charge you a lot of money, and they can take actions that you can do yourself. Okay, we have the Balance website. The Balance website is our vetted partner, and you have all kinds of access. I'm going to include that in the email. All kinds of access to podcasts and videos and written materials that you can download for free. You don't have to create a profile or anything like that, like most places do nowadays, right? And you can get on the phone and talk to them with a counselor over there. Again, if you're in serious trouble, contact me. Send me an email. We'll see what we can do on our end, and I will put you in touch with a counselor over there. And this slide really just wants to make sure that, buyer beware regarding any of these kind of credit repair companies. And by the way, despite any claims by one of these companies, they have no ability whatsoever to remove accurate information from your credit report. Okay? If they claim that they can, they're not being honest. And that's how I'll say it. Okay, next slide. Identity theft. We have a whole separate webinar on identity theft. Again, let me reiterate, always keep an eye on your credit reports throughout the year. Every 4 months, get one of those, okay? Annualcreditreport.com. I know a couple people, experts in the area, so the next time we do an ID theft webinar, I'm probably going to bring them in because they know their stuff a lot more than I do. Yeah, the bullet points. I know a couple times during the year in Evanston and the city of Chicago, they have these shredding events. You want to take that stuff and get that stuff shredded. I'm there every month with bills. I'm like tearing these things up like with my name, with all the letters, trying to separate all the letters in my name, and I toss them all away. So just it's a nightmare. This ID theft. So always keep your eye on the report. I had someone, what was it? Yeah, back when I was in college, I got a call from a company in Wisconsin, and a hotel, and they said, "Hey, you owe us $1,500." I said, "What?" And they said, "Yeah, you were here making all kinds of calls, charging all kinds of things." It turned out some guy had a friend at the DMV, and he matched my information. So his buddy at the DMV put his picture with my information. It was resolved. I actually found the guy, but it could have been a potential big problem. Another thing was someone at Amazon. They actually tapped into my account and they mailed me an item that they ordered somehow. I don't know how that happened. I think it was maybe some sort of trial run for something more nefarious, but people are crazy. So just it's, we've had nightmare stories from members who have gone through this ID theft stuff. It's not fun at all. So just shred everything. Okay, next slide. Damage control. So there's specific steps that you can take if you find yourself a victim of ID theft, and you just follow these bullet points. Definitely file a police report. Contact the credit bureaus. Contact your creditors. Let them know what happened. Put a note on that credit report. Okay, next slide. Other types. Okay, so again, there's other types of credits of reports that creditors use, and I think it's on page 6 of the handout. It lists these other things like this check systems. This is what banks and credit unions use when somebody wants to open up a checking account. This information just shows if somebody was overdrawn and they closed out the account and never made good on it, overdrawn the account, they bounced checks. That's the check system, the national tenant network that's used by landlords. it reports evictions and non-payment issues. It's not really, I'm not familiar with it really. But outside of the well-known FICO model that we just went through, there are a bunch of different other models, like, and I'm just going to touch on a couple of them. And we have 4 different credit report webinars that we do. We get into more of the minutia on those other things, but something like they call the Vantage score. That's something that actually it was created by Equifax, Experian, and TransUnion back, I don't know, like 15 years ago. It's an alternative to the FICO score, but it looks the same. The data, they look at the same data as FICO, and you know, in all of these other models, the bottom line is whatever you need to do to keep that FICO score as high as you need to and not let it drop, you know, it's the same stuff, right? You know, pay the bills on time and all that stuff. I think this Vantage, I think you're able to get your credit score a composite if you have credit less than 6 months old. I think that's it. I think that's the main thing with it, with the Vantage score. But all the same weighted factors that we just went through, all these other models are looking at the same thing, and there are internal scores that are utilized by companies. That it's their internal scoring modules. But again, generally, if you make your payments on time, you keep your balances low, you practice the good habits that we just went through, everything that makes a good FICO score will be a good score under any of these models, okay? Next slide. Final thought. Wow. Okay, do I have a final thought? I think my final thought is, you know, obviously we all want excellent credit and excellent credit history, and we know that life throws a bunch of curveballs at us, but just know you can always repair whatever damage that has been done, okay? So never give up hope. And as I mentioned, we do have a credit rebuilding program, and it works like this. So we call it Credit Sense. So we give you like $1,500. We put it in an account. We call it a Credit Sense loan. Okay. Well, let's say it's $1,500. After 6 months of on-time payments, we will give you the opportunity for a Credit Sense Visa. Payments have to be made on time, right? And so by the end of the year, after all is said and done and the $1,500 is paid off, at that point, the money is yours. So it's a credit rebuilding and a savings program at the same time. During that whole year, every time you make those on-time payments, we are letting the credit bureaus know that you just made another on-time payment, and that is how you rebuild it. It's this loan we put in the account. You just simply make payments to the loan. You pay that down, or you pay that off, and you get to keep the $1,500. So it's a savings. It's a savings plan as well. Okay, so it's an awesome program. Plus, we have a program with Balance, and then we kind of commingle it at the same time that I mentioned before. So let me see if I can. I'm going to do something. Let me close this out. And let's see if it's here. Here. Oh, you see this? You guys see this? This is where you go. evanston.balancepro.org. And I mentioned the certificate program before. This is so you would come here. And on this, for this program, a certificate program, you would actually have to create a profile, okay? And you have to, and I'm going to send you the directions and stuff. All you have to do really is watch like these videos, like 10, 15 minutes at the most, like 9 videos we set up for you. This is Balance, and they're a vetted partner. We use them all the time. They help us put together the slides that we just saw. But all you have to do is watch these 9 videos, and what happens is you get a certificate. You checked out the modules, you get the certificate, and we come back to that Credit Sense program. And instead of 6 months of those on-time payments where you can then apply for the visa, we shorten it by 3 months. So you could do that after only 3 months instead of 6 months. So it's well worth spending the hour and a half just watching these 9 videos, okay? So it's easy peasy, as they say. And I think that is it. I want to encourage everybody to, any questions whatsoever, send me an email. We bring people in all the time to go through credit reports. You could do that. I set you up with an FSA or the branch manager here in Evanston. Or if you're downtown, we have a branch downtown. I go to Streeterville every once in a while. So send me an email. I will send you guys an email probably tomorrow, maybe even later today. And so you'll have all my information. And you can ask more about this, and I will send you the attachments that are here. And I want to see if there's any questions. I think I went through that and that. I'm going to give another minute. If anybody has any questions in the chat area, go ahead and ask. Otherwise, let me see. Now we covered that. We covered that. Yeah, credit utilization ratio. Right. It's just revolving. Just using revolving credit. Okay. Let me see. We have one more. Okay, I think I just lost an email or a question that came in. I apologize. I'm technically challenged. So on that note, okay, I'm going to let you go. If you have any questions, email me. And I appreciate you guys coming out today. All right? Okay, bye.